Welcome to SR Money News. Today, we dissect the shifting architecture of the U.S. stock market as Wall Street prepares for a monumental week defined by the Federal Reserve's policy decision and critical artificial intelligence earnings. At the heart of this narrative lies the core business moat of the magnificent 7 megacap technology firms, specifically Alphabet, Microsoft, Amazon, and Meta platforms. These giants have built incredibly resilient core operating segments, from cloud computing infrastructure to digital advertising monopolies. Their primary value proposition is simple: generating massive cash flows from mature businesses to fund the next generational platform shift. Think of this core business moat as an impenetrable castle wall, where steady revenue from search engines and e-commerce acts as the gold treasury, funding the expensive expeditionary campaigns into the uncharted territory of artificial intelligence. Transitioning to quarterly results, recent earnings have triggered a fundamental reassessment of capital allocation. Alphabet and Tesla have already reported, igniting significant market unease regarding their surging capital expenditures, commonly referred to as CapEx. CapEx is the money a company spends to buy, maintain, or improve its fixed assets. Think of it like a restaurant buying incredibly expensive, state-of-the-art commercial ovens. While the kitchen's potential increases, immediate cash reserves dwindle before a single new dish is sold. For Alphabet, despite solid top-line revenue growth, investors reacted negatively to the dramatic rise in infrastructure spending needed to support AI. Similarly, Tesla's margins compressed as its heavy investments in autonomous driving tech clashed with slowing automotive revenues. The immediate financial implication is clear: the market is no longer grading these companies on promises, it is demanding near-term margin expansion. This brings us directly to the balance sheets of Microsoft, Amazon, and Meta platforms, all of which are poised to release their own artificial intelligence spending updates. Analysts are focusing heavily on free cash flow generation and margin contraction. Margin contraction occurs when operating expenses grow faster than revenues, narrowing the slice of profit left over. It is similar to a bakery spending more on premium flour but being unable to raise the price of its bread, resulting in smaller profits per loaf. Investors are hyper-focused on whether the billions of dollars allocated to graphics processing units and massive data centers are translating into cloud revenue acceleration. The forward-looking structural shift is profound. Wall Street is moving from a phase of speculative valuation, where future growth was taken on faith, to an era of strict operational efficiency, where every dollar of AI investment must prove its return on capital. Analyzing corporate leadership, management commentary during these earnings calls will be highly scrutinized. Executives are tasked with defending their capital allocation frameworks. We anticipate Meta's Mark Zuckerberg and Microsoft's Satya Nadella to provide detailed monetization timelines for their generative AI software suites. The key term here is forward guidance, the management's official projection of future earnings and business conditions. Think of forward guidance as a ship captain giving the crew and passengers an updated weather forecast and route plan during a stormy crossing. It aligns expectations and builds trust. If management suggests that high capital expenditures will persist for several years before yielding meaningful top-line growth, the immediate financial implication could be a tactical repricing of these equities. Investors are looking for a disciplined balance between ambitious long-term R&D and defensive capital preservation. Zooming out to the broader industry context, these earnings report cards are landing in a macroeconomic environment fraught with tension. The Federal Reserve's looming policy decision is the focal point of global credit markets. Traders are searching for signals of an impending policy pivot, specifically regarding interest rate cuts. High interest rates act like gravity on financial markets. They make borrowing expensive, compressing corporate valuations because future cash flows are worth less in today's dollars. Think of high interest rates as a steep uphill climb for a cyclist. It requires far more energy to make the same progress. If the Fed signals that they are ready to lower borrowing costs, it could loosen credit conditions, injecting liquidity back into the system. This macro backdrop is critical because even stellar corporate earnings can be overshadowed if the central bank adopts a hawkish tone, reinforcing restrictive financial conditions. This macroeconomic tension has triggered an intense capital rotation across Wall Street. Capital rotation refers to institutional investors moving their money out of high-performing sectors and into underperforming or defensive sectors. It is like a manager of a sports team subbing out tired star players to bring in fresh, rested bench players to secure the game. Recently, we have witnessed capital flowing out of mega-cap technology and into small-cap indices and defensive value sectors, such as utilities and consumer staples. This shift occurs because investors are seeking asset insulation, investing in businesses with stable demand that can withstand economic slowdowns. The immediate implication is increased daily volatility for the NASDAQ and S&P 500, which are heavily weighted toward tech. The forward-looking structural shift indicates that the market is preparing for a multipolar environment, where technology is no longer the sole engine of equity returns. Despite the promise of AI, significant risks are clouding the tech sector's outlook. Systemic headwinds like cost inflation on advanced semiconductors and rising energy demands for data centers are putting pressure on operations. Additionally, regulatory scrutiny remains a constant threat, with antitrust investigations targeting search and cloud dominance. Valuation multiples also pose a major vulnerability. A valuation multiple is a financial metric used to evaluate a company's worth by comparing its stock price to its earnings. Think of it like buying a house. A high multiple means you are paying a premium price today because you expect the neighborhood to become extremely desirable in 10 years. If the neighborhood's development slows, you overpaid. With megacaps trading at historically elevated multiples, even minor misses in revenue guidance can trigger severe corrections. The immediate financial implication is heightened downside risk for portfolio managers who fail to diversify. Looking forward, the structural outlook for the U.S. equity market demands a highly selective approach. We are transitioning away from the tide that lifts all boats to an environment that favors businesses with strong pricing power and solid earnings visibility. The forward-looking shift indicates that artificial intelligence will remain a multi-year growth driver, but the winners will be redefined. No longer will simply mentioning AI trigger a capital injection. Instead, companies must demonstrate clear pathways to monetization and operational efficiency. Valuation reassessments will likely continue as the market prices in the Federal Reserve's long-term interest rate trajectory. Portfolio managers must maintain a focus on asset insulation, prioritizing balance sheet health and cash-generating resilience over speculative potential. The narrative of the coming months will not be defined by market-wide exuberance, but by surgical, company-specific execution. Navigating this complex macro landscape requires rigorous analysis and objective insights. As we watch the Federal Reserve's decision and the tech sector's earnings unfold, staying informed is your greatest asset. If you value this level of institutional-grade market intelligence and deep portfolio manager thinking, ensure you are positioned for the shifts ahead. Subscribe to SR Money News, turn on notifications, and join our community of sophisticated investors who prioritize structural understanding over market hype. Analyze the risks, understand the macro forces, and insulate your assets with discipline. Let us know in the comments how you are positioning your portfolio for the upcoming Fed decision and AI earnings. Thank you for watching, and we will see you in our next deep dive analysis.